This voice is taken from an article with the title, How Does the Fear and Greed Cycle Influence Market Behavior?, which has been published on TRADERTALKSNET. The fear and greed cycle is a phenomenon that is often observed in the markets. It is the tendency of investors to act in a cyclical pattern, alternating between periods of fear and periods of greed. During periods of fear, investors become overly cautious and take a conservative approach to investing. They are more likely to buy safe assets such as bonds and cash, and they will be less likely to take risks. This can lead to lower prices and a decrease in liquidity in the markets. During periods of greed, investors become more confident and take a more aggressive approach to investing. They are more likely to invest in higher risk assets such as stocks and foreign currencies, and they will be more willing to take risks. This can lead to higher prices and an increase in liquidity in the markets. The fear and greed cycle can influence market behavior in a number of ways. One of the most visible effects is the tendency for prices to move in waves, which can be attributed to the buying and selling activity of investors. When investors are fearful, they will generally be selling their assets, which drives prices down. When investors become greedy, they tend to buy more assets, which pushes prices up. The fear and greed cycle. It can also influence the market's overall sentiment. When investors are fearful, they tend to focus on the negatives and are more likely to see market conditions as unfavorable. On the other hand, when investors are feeling greedy, they tend to focus on the positives and are more likely to see market conditions as favorable. This can lead to changes in the market's overall sentiment, which can affect the market's performance. The fear and greed cycle can also lead to increased volatility in the markets. When investors are fearful, they tend to sell their assets quickly, which can lead to sharp fluctuations in prices. Conversely, when investors are feeling greedy, they tend to buy more assets quickly, which can also lead to sharp fluctuations. Increased volatility can lead to greater risk for investors, as sharp price movements can lead to losses as well as gains. Finally, the fear and greed cycle can influence the markets in terms of liquidity. When investors are fearful, they tend to move their money into safe assets such as bonds and cash, which can reduce the amount of liquidity in the markets. Conversely, when investors are feeling greedy, they tend to move their money into higher risk assets such as stocks and foreign currencies, which can increase the amount of liquidity in the markets. In conclusion, the fear and greed cycle can influence market behavior in a number of ways. It can lead to price fluctuations, changes in sentiment, increased volatility, and changes in liquidity. Investors should be aware of the fear and greed cycle and its effects on the markets in order to make informed decisions when investing.